Alright, today is Friday, October 2nd, and this is a post-market review for the stock market activities today. And what a day it was, and what a night it was. I will get the elephant out of the room right away. We did have news that the President of the United States had contracted COVID-19, and that rattled the market, specifically early in the morning during the futures. However, we saw the markets being rescued due to the re-emergence of stimulus hopes. We will of course keep an eye on the president's condition during the weekend because things could develop really fast from this point on and will have gigantic ramifications in the markets. I do have the story, all the news up to the hour of the recording of this video regarding the health of the President of the United States. We will cover that in the headlines segment of this video. But we will also talk about the market's closing, the sector's performance from a daily perspective and from a weekly perspective, what happened in the futures market, very interesting action in metals, and of course the options market and what traders are betting on given the information. And of course, we will switch things up and cover the heat map from a daily and weekly perspective. We will do the analysis. There are interesting findings there. And of course, we will look at the rotation trade and what happened from a daily and weekly perspective as well. Then we will move to the headlines that shape the day. After that, we will cover some charts. We do have the SPY, the Qs, the VIX, dollar index, gold, Apple, Tesla, and then we will conclude with a scenario analysis of the outcome from the COVID crisis that hit President Trump and how different scenarios will impact the market. And that would be the conclusion of the video. We'll have a message there, so stay tuned. And here we go. The Dow Industrial Average closing in the red, a decline of 134.09 points or a retreat of 0.48%. The Nasdaq down 251.49 points or a decline of 2.22%. S&P 500 in the red, 32.38 points or a decline of 0.96%. Here is the sector's performance. The gold medal for the day goes to real estate, silver to utilities, and the bronze to industrials. The laggards of the day, communication services, tech, and consumer cyclicals. And switching to the weekly performance of the different sectors, the gold medal again goes to real estate. Excellent performance for real estate this week. Utilities again with the silver. However, the bronze this time around for the weekly performance goes to consumer cyclicals. And the laggards for the week, of course, energy got whacked significantly this week. Financials and communication services. What's going on in the futures market? Let's start with the action in metals. You see copper had an excellent rally today, but it wasn't the picture during the overnight session. Matter of fact, as you can see from the chart, right away after we heard the news that the president has been infected with the virus, copper declined significantly. And that was, of course, the knee-jerk reaction, so you always have to be careful about that. And perhaps the entire action of the day today was a knee-jerk reaction, so we have to be very cautious. I will talk a little more about that in the conclusion of the video. But here it is, copper rebounding during the trading hours and capturing significant gains. Different story in gold. Gold caught a bid after the news were announced. I will see that more during the charts analysis. However, gold retreated during trading hours and gave up the overnight gains. What's going on with softs? We see coffee trading in the green today. Here is the chart for coffee. And of course, I did open trades in the December contract in coffee. And the reason is, you see, of course, from a 15 minutes perspective, the coffee is forming a bull flag formation, readying for a move higher. And when we switch to a daily perspective of the chart, you can see that 107 support level held solidly, and it remains a very strong support for coffee. And we do have a potential curling and crossing of the daily MACD to the positive territory, creating green impressions in the histogram, and that would be a very good signal for an upcoming rally and a recovery in coffee. Now the laggards in softs today, lumber. What about grains? Soy meal gaining today while soybean oil declining. Switching things up by moving to the heat map analysis right away. As you can see, from a daily perspective, we've seen an exodus from the big momentum stocks today. For instance, look at the consumer cyclicals section. Internet retailers, specifically Amazon, is down and Tesla is down as well. But the rest of the sector did pretty well. Today was a judgment against the big momentum stocks. They're being sold and lagging names, specific lagging names, caught a bid. And of course, we saw the rush to safety, as you can see, from the utilities and real estate sectors. Also, stimulus-sensitive names caught a bid today upon the news that stimulus talks will resume over the weekend. You saw airlines catching a bid, cruises to a certain extent lesser than the airlines, but specifically the airlines, because we know at least they will carve a deal out to bail out airlines. Of course, to prevent the upcoming massive wave of layoffs in the airlines operators. We also saw materials and industrials catching a bid. These two sectors are dollar sensitive, and we saw the dollar decline just a little bit and stayed muted throughout the day. Furthermore, lots of the industrial names will benefit if we have a wholesome stimulus deal passing. And of course, we must be very cautious and not make conclusions from today's action only, because this could be just a knee-jerk reaction and we will see the true market reaction during next week and the days to come. But let's switch to a weekly view here of the heat map. Right away, you can see the performance of FANG, the big tech names. Not very impressive, with exception of course of Netflix. And the action in Netflix of course could be due to a surge of call buying in the options market. There's a certain individual who is responsible for a surge in call buying this week. We will talk about that in the headlines segment. You saw of course financials bounce. That is probably not sustainable at all. Utilities, real estate, stellar performance for the week. We also saw a theme of picking in the market, where a certain name outperformed other names in the same sector. Case in point, look at the performance of Intel outperforming Nvidia, or in the energy sector right below, Chevron outperforming ExxonMobil. And of course in industrials, specifically defense, Raytheon outperformed Northrop Grumman significantly. Another theme is silent rallies in certain names. They rallied significantly and noticed throughout the week. Evident, of course, with the performance of Uber. Uber did amazing this week, so did General Motors, bouncing from the losses of last week regarding the whole Nikola saga. We do have a decent rally in Boeing, about 7% or so. And of course, we do have Anthem, Blue Shield in the healthcare sector, also did its own silent rally, while all eyes were on big tech. To get a clearer picture, let's look under the hood and cover the rotation trade. And right away, of course, from a daily perspective, you can see that the reopening stocks, of course, outperformed the momentum stocks / stay-at-home stocks. The reasons could be varying from number one, the stimulus hopes. Stimulus would obviously target weaker sectors and lagging sectors in the economy. It could have been also the knee-jerk reaction of dumping winners, in this case the momentum stocks, taking profits and rotating that toward lagging names. We'll see if that strategy sticks and gather momentum during next week in the days to come. But of course, the action in the stay-at-home stocks, specifically Peloton managed to rally today, shows you that the gambling mentality and the buy-the-dip crowd mentality is still there. It is unhealthy, and it will require furthermore downside overall for this mentality to leave the market. Peloton, of course, is rallying due to the direct action in the options market. Gamblers have decided to buy Peloton calls, specifically the 120 expiring this month. What happens, of course, is option riders have to accumulate shares of Peloton as a hedge. And that, of course, creates the famous gamma squeeze and the pump and dump. So it's just a matter of time before option riders accumulate enough shares, make enough profits, and then decide to dump the stock. But here is a weekly performance of the rotation trade. And as you can see, we have green across the board in general. However, the reopening stocks, all in all, outperformed the momentum stocks. You saw, of course, Shopify and Peloton outperforming in the momentum stocks, but we also saw significant outperformance in the reopening comeback names such as American Express, TJ Maxx, Cheesecake Factory, General Motors, all rallying significantly this week. Again, it is the silent rally theme. And of course, the question here, we don't know what's going to happen to the president over the weekend. On Monday, either we're going to have good news that the president is feeling better and we can put that episode behind us, or the situation could become even more uncertain and his health deteriorates further. How would the market react? Because we have this mentality, this bipolar mentality, that taking cash out of the market is forbidden. It's a sin. What you do is you shuffle and you play the yo-yo game, shifting from one sector to another, from the reopening stocks to the stay-at-home stocks, then back and forth, meaning that there is always a place to hide in the market. We will see if this is true, whether we will see a rotation, a significant rotation from momentum names to the laggards, aka value stocks, or whether we're going to see a panic. We have yet to see a panic during this sell-off. We saw a panic back in February during the COVID correction, but we haven't seen a panic here yet. And if we panic, we will shift to the mentality that there is nowhere to hide. Everything will get sold off, and perhaps you will finally see investors raising cash and perhaps shifting into gold, at least for the time being. For now, the shuffling and hiding between sectors goes on. And now, moving on to the big casino, the options market. We saw some action today, of course. Apple leading the pack with 2 million contracts traded today. About 64.5% of those were calls. Tesla number 2 with 1 million option contracts traded today. 56% of those were calls. American Airlines comes in number 3 with 580,000 contracts traded today. 78% of those were calls. This is of course due to the anticipation of the stimulus deal passing over the weekend. Airlines names would rally significantly as a result. But specifically, of course, American Airlines, because it has the highest beta, meaning it has the tendency to move up or down higher than other names in the same sector, which makes it, of course, a favorable table for the option market's gamblers. Now, let's take a look at the volume leaders. Apple leads the market per usual. You can see bullish bets here for Apple buying the 120 call, the 115 call, but also making bearish bets buying the 112 put, all expiring next week. I hope that Tim Apple and company over at Apple are very happy at what they've done to the stock. Ever since the split, Apple has become a casino where we see a stampede of traders buying calls, puts. They don't even bother buying the stock. It's all being moved via trading options. And if you are a serious investor who's buying Apple stock to buy and hold for the long term, you have never experienced such volatility in a short amount of time. Apple, the largest stock in the market, is supposed to be a safe stock, meaning it moves steady eddy to the upside, and it has, of course, serious corrections along the way. This is what we are accustomed to as investors in Apple stock. But these days, the stock moves up 5% in a day, down 5% the next day, and at some point, disciplined investors who've been holding Apple for years will not be able to stomach this anymore. The stock has been ruined and it became a swamp of gamblers. Unbelievable. Now, let's take a look at the decrease of open interest. Which trades are being closed? Right away, I see a trade here at Exxon, closing the 32.5 put, expiring in January 21. Perhaps the trade here is a bet that we will see at least a short-term bottom in Exxon and energy names. It was a horrible week for energy. Perhaps next week could be a rebound for this sector. And of course, we saw the Apple 120 call. We've been looking for this trade every day of this week and we found some. And here is a continuation to the theme. Closing the 120 call, expiring next week. And of course, you see the contrast between disciplined traders who are closing these calls, taking whatever profits in there, and between the gamblers who are stampeding to open new contracts in the same trade. This is what makes a market. And of course, we do have Uber closing the 37.5 call, expiring October 23rd. Perhaps the trade here suggesting that the recent amazing run in Uber will come to a halt and Uber would decline from this point on, taking chips off the table. Now, before I finish the coverage of the options market, I want to teach you something. During this very volatile times, if you do make a trade in options and you score some profits, don't let the position extend without taking your profits off the table. Lesson number 1, always be closing. Specifically, if you enter the trade without a thesis, you're just rolling the dice. Take your profits. Always be closing. Now, if you enter a trade based on a thesis and it works, then of course you know at which point you're going to stop and you take your profits. You are now a disciplined options trader who doesn't just roll the dice with no thesis. Likewise, you have to learn how to close losing trades. Not every option trade you're going to make will be profitable. For example, earlier in the week, I opened a put contract for DraftKings. My thesis, of course, was that I saw traders closing their call options in DraftKings, taking profits off the table. We also had a bearish reverse hammer pattern at the time in DraftKings chart. Now that didn't work because DraftKings rallied right away and continued to rally throughout the week. Right away when my thesis was gone, became scrambled eggs and the reverse hammer did not work and we saw a surge of call buying in DraftKings. I closed the trade at a loss. Always be closing, even if it is taking a loss. The skill of taking a loss is at a higher level than taking profits. Traders who know how to take a loss are usually more successful than those who don't. So always be closing. And of course, the second lesson.
Now pay attention, 007. I've always tried to teach you 2 things. First, never let them see you bleed.
And the second?
Always have an escape plan.
And now, to the headlines that shaped the day. And what a headline it was. We have found that the President of the United States has been infected with COVID-19. Of course, the backstory is that his closest assistant or advisor, Hope Hicks, got infected with the virus. And of course, we all know how much does Trump totally love and adore this man. Excuse me, this lady. Oh, and he likes to be very, very close to her. Certainly closer than Melania would like. So, it was logically a matter of time before we hear that the president himself got infected with the virus. And indeed, a little after midnight Eastern time, we heard the news via a tweet. And you saw right away the decline and the reaction in stocks futures. Trump certainly might have thought that the worst thing that he can contract from Hope Hicks by getting very, very, very close to her is herpes. But turns out that you can get COVID-19 too. And he found that the hard way. And the last thing we've heard, of course, is that the president is taking the Regeneron treatment that was announced. The results of the treatment, the trial, was announced just a few days ago. Who knows how good this treatment, because it is experimental at this point. And of course, we know that the president was transported via helicopter from the White House to Walter Reed Hospital, where he will remain a resident for at least a little while. He will spend a few days there. Certainly very alarming. However, we saw pictures and videos, for that matter, of the president walking on his 2 feet all the way to the chopper. So he appears to be at least in an okay condition for now. That's what you get when you get very, very, very close to Hope Hicks. But moving on to another important piece of news that was released in the morning, yet got buried beneath the Trump COVID news, the jobs report. And of course, the results were we added 661,000 jobs in the month, compared, of course, to 800,000 jobs expected. A big miss, a big disappointment, but the market was thinking about something else, and it didn't matter at this point whether it's a miss or a hit. The market, of course, and this is very important, is in the mentality of searching for any little hope, any little optimism to rally. And when they heard the news about Trump and the jobs report, you saw the buy the dip crowd, the morons running Naruto style, buying stocks, because in their heads now, a bad jobs report and a sick president will accelerate stimulus hopes, which tells you that the momentum in the market is still alive. And we are not at a point where we're ready to break in the market yet. Keyword yet. Continuing regarding the jobs report, and perhaps the most disturbing part of the report, and you can see the report right in front of you, and this is the piece of information I'm talking about. Permanent unemployment and permanent layoffs up 345,000 this month to a total of 3.8 million. Unbelievable. And when you look at the chart, we are closing to the 2009 crisis record. Furthermore, the labor force participation rate dived lower, meaning more people are giving up on finding jobs. Now, of course, we know an increasing number of the young male population have stopped looking for jobs and they're doing Robin Hood instead. And a lot of the younger female population stopped looking for jobs and they're doing OnlyFans instead. One of these two demographics will end up keeping their profits. And my guess that it is not the Robin Hoodiots males. The girls are smarter here. This is, of course, the Robin Hood OnlyFans economy. And moving on, of course, to another piece of information we found out. People who are not in the labor force, yet they are looking for jobs. The number is 7.2 million people. And of course, where the gains, the 600,000 plus jobs that we added this month. As expected, and as I told you, it is in the food services business, meaning we added waiters, cooks, bartenders due to the opening or the lifting of restrictions on restaurants across the nation, specifically allowing outdoors seating. Here is the problem. As we get to the colder part of the year, some of these restaurants are not going to be able to open for outdoors seating. You can't have a restaurant in Minnesota having outdoor seating while there is a snowstorm outside. So we will lose some of these gains absent of a vaccine or treatment by that time, and the window is closing. So perhaps the outlook for the job market is getting negative from here. Also, we've added 69,000 jobs in amusement and the gambling sector. Of course, take out the 28,000 employees that Disney is planning to lay off from that number. We are trending downhill from here. Speaking of downhill journey, let's talk about propaganda minister Larry Kudlow. Kudlow, of course, appeared on Fox Business, and he said that the president's condition is mild and that the jobs report was alright, but don't ask me about it. Let's talk about the president's condition instead. You know why? Because Propaganda Minister Kudlow a few weeks ago said that the September jobs report is gonna be very good. Because remember, Kudlow is a believer in the very steep, very sharp, steep V-shaped recovery. And what do you know? The September jobs report was a disappointment. But of course, we know that Kudlow lives inside the booze bottle. But here is the information we uncovered on Larry Kudlow. And it was a slip from the White House, whatever the hell he does, Mulvaney, who was out on Fox Business as well. And he said pretty much that the White House sends Kudlow to this network to pump and rescue the market. So if you had any doubt, now you know. Of course, the Kudlow pumps worked back in 2018, maybe the earlier part of 19. But as we found out that Kudlow is a propaganda minister and his credibility went down the toilet, and now every time he comes out trying to prop up the market, he ends up crashing the market instead. And of course, speaking of very vile and sketchy characters, Jim Cramer of CNBC. Jim Cramer, of course, appeared in the morning and he said, you should have a list and you should start buying the dip. And we know, of course, that Jim Cramer is a professional pumper. He gets paid to pump stocks, and he's not recommending to buy the dip here in value names or anything like that. He would recommend Nvidia and Shopify in the same names that are running very hot to begin with. Furthermore, a few weeks ago, Cramer said that if we don't have stimulus, the market would crash. Yesterday, Cramer said that the market doesn't care about stimulus anymore. But as we have seen from the action today, the moment Nancy announced that stimulus talks will continue and perhaps she will carve out an airlines deal in the stimulus, you saw the stock market recovering, and that was the bottom of the day. So which is it, Cramer? Does the stock market cares about stimulus or it doesn't care about stimulus? I tell you what, you don't know. You just flip-flop like a pancake day after day based on the market action. You have no credibility, no ethics, and no consistency whatsoever. And of course, Cramer is saying that he will close his restaurants. Remember the backstory, Cramer defrauded the PPP loan program, took millions of dollars for his quote-unquote small business that was struggling. And we know that Jim Cramer is a millionaire and he need not to receive PPP loans. He can rescue his own restaurants out of his pocket. But why not take advantage of the generosity of the taxpayer? And now that he hit the October deadline, where he need not to keep employees on the payroll to keep the money he scored from the PPP loan, what does he do? He closes the restaurant. I'm probably gonna fire the employees and he gets to keep the cash. Professional fraudster. This man would sell his soul for $1. Moving on, we talked about Nancy. Nancy came out and said, hey, airlines, hold your horses. Don't furlough your employees because I'm coming to the rescue and I will pump the market by announcing that me and Slimy Mnuchin are going to talk about talking about the stimulus, so long as the market doesn't crash. But of course, we know that both parties agree that the airlines must be bailed out, otherwise there will be a tsunami of layoffs coming. So expect at least a mini deal regarding the airline sector. And now, moving on to the charts analysis. Starting, of course, with the S&P 500. Here is a 15 minutes perspective. All we've seen today in the SPY is a gap down opening, and right away you saw the Robin Hoodiots stampeding to buy the dip. And of course, these morons, even if there was a mushroom cloud visible from their window and the world is coming to an end, they will still buy calls and buy the dip in the stock market. They're zombified traders programmed on autopilot to buy ask questions later. Matter of fact, don't ask questions. And we saw, of course, that little pump in the morning failing and fading until, of course, Nancy showed up and said all what she said about the stimulus deal. And that was the Nancy put. And the market, of course, recovered and rallied from that point. However, we saw the market fading out again as we got closer to the closing bell. Yet the Nancy put remains the bottom of the day. And here is of course the chart of the SPY from a weekly perspective. It is getting clearer that we are seeing an ABC pattern where you see a decline and then a leg higher of a bounce, dip buying, short covering before you see a resumption of the original leg lower where the selling resumes and dip buyers take their profits and shorts start shorting again. A, B, C. Likewise, here's the Nasdaq, the Qs from a 15 minutes perspective. You see the Nancy pump right in front of you. It didn't work as well as it did work for the SPY because the market, in this case the Qs, starting melting down in the afternoon. And of course we closed below 274.44, which was the gap lower support. We're not going to make a big deal out of it because the number differs between technical analysts. My number is 274.44. Another analyst could be 275, 273.80. It doesn't matter. It is around this zone where we find support. And of course, to see a better picture of support and resistance, let's take a look at the 1 hour chart of the Qs. When a chart trends lower and then it starts to recover, prior gaps where the market broke down become a goal to achieve and they become resistance. Once they're broken, they become support. Likewise, on the way down when you reverse, any gap from the movement higher now becomes a goal to achieve and it becomes support, and if you break below it, it becomes resistance. Very simple stuff. And with that understanding, you can see that the resistance we have right now, assuming that we closed below the gap, it is 274.44. And then we do have support, the next support at 271.77. That of course coincides with the gap higher that we did when we moved in the northern direction. And if that fails and doesn't hold, of course we do have support number 2 at 260. 260 has been proven to be a very solid support. Breaking 260, you know what that means. The domino effect. Stops will be hit, margins will be called, and you will see a cascade tsunami to the downside. And of course, here is a daily perspective for the Qs. Let's present the bullish case first. The bulls would say that we have a potential reverse head and shoulder formation from a daily perspective. Yes, we could decline, but that would be the other shoulder and we will trend higher from that point on. However, here is the bearish case from a weekly perspective. A more impactful chart. And you can see, of course, the ABC pattern as we've talked about in the SPY. A leg lower, a reaction of dip buying, short covering, and then you continue again to the same direction you started and began with. Moving on to the Dixie, the dollar index, 15 minutes perspective. The dollar behaved as expected. It was trending higher after it took a break. However, upon the news and the announcement of the Trump COVID situation, the dollar was confused for a little bit, blasted higher for a minute or two, and then it reversed course, significantly trading in the negative territory. But as the session started, the regular session, you saw the dollar stabilizing and pretty much ending up flat to muted. Now, when we switch to a daily perspective of the Dixie, you can see we do have an ABC pattern, a bullish one in this case, and it is a mirror image to the Qs here. You see the Qs having a bearish ABC pattern, the Dixie having a bullish ABC pattern, and if things work as we expect them to work, the Nasdaq will continue to decline in the next few weeks while the dollar would rally until it becomes exhausted. Remember, the dollar is being very shorted right now, and there's plenty more of short covering to go. Moving on to the VIX, we do have, and talked about this yesterday, weekly perspective, we do have the bull flag formation, and we said the VIX need to give us a signal in the bullish destination by today. And what do you know? We had a green closing, and as you can see, the bull flag formation appears for now to be working, expecting further gains for the VIX in this upcoming week. Moving on to gold, a daily chart. Right after the announcement of the Trump COVID news, you saw gold rallying significantly. However, that was a knee-jerk reaction and gold corrected, trended lower, and actually ended the day in the red just slightly. it was muted throughout the day. Remember, my target is 1925. I expect resistance there, and I expect, of course, my projection that gold is having a bounce, and of course, it will reverse course and retreat lower because the dollar is not finished with its move yet. Of course, anything could happen from this moment on regarding the president's health situation, and that could change the course completely for the dollar index and gold. So we are making certain understanding by looking at the charts, but you have to keep the news in your mind. Moving on to Apple, 15 minutes chart. You can see that Apple declined today. However, the 113 support remained solid and Apple closed above the support. That is bullish from a 15 minutes perspective. But when you look at the big picture from a weekly perspective, we talked about the MACD, the crossing of the MACD, making red impressions, signaling the beginning of the correction that we are not through yet. There is further decline in Apple's stock. You can see that when you switch to the daily chart that we do have the support at 106. 106 remains the most important level to watch. Breaking 106 will produce significant pain in Apple shares and the market overall. But Apple has been noticeably weaker this week. And the last but not least, Tesla. A daily chart, Tesla declined over 7% today. We talked about the breakage of the wedge, whether it was a fake out or no fake out. Yesterday we had a confirmation candle that it is not a fake out, but what do you know? It turns out to be the ultimate fake for now, reversing the last 2 days of gains. But it remains important that Tesla did not pierce below the upper wedge line. So it could be read and interpreted as a breakage of the wedge and then revisiting the line before bouncing higher again. Therefore, we need to look at the big picture, the weekly chart. And as you can see from a weekly perspective, Tesla chart managed to cross the blue line average in the MACD indicator just by a hair and making a red impression in the histogram, signaling that perhaps the positive trend that Tesla has been on for weeks now is about to be broken and we will see further decline in Tesla. For me, I doubled down on my puts today. And now let's move on to conclude the video and talk about the Trump situation. Now we know that he's been taken care of with the best clinical treatment and observation in the world. With that being said, if the president's health deteriorates and he ends up dying from COVID, the market will adjust to a scenario of Biden's presidency. If that takes place, of course, the VIX will explode, the market will trend very lower, and of course, investors will shift to the Biden presidency playbook, which is sell everything and lock the capital gains for the year before they increase under the Biden's administration. However, let's say the president lives. There are two important aspects to look at. His attitude. Will his attitude change now? Will he become more cautious and say we don't need to reopen prematurely? And perhaps we need to give the vaccine its time. And we need to mandate masks. And maybe there are instances where we should lock down again. That would be very bad for the reopening stocks, and the stay-at-home stocks will benefit from that. You will see a further rally in tech names and momentum names, while the reopening names will suffer. However, and this is perhaps the most likely scenario, is that he will emerge even more reckless than he was before because he got the disease, he got the treatment from Regeneron, and now he's feeling better and hey, it's not a big deal. It was just a mild flu in his mind, of course. And now he pushes harder to reopen schools and open states and pushes harder to approve the Regeneron treatment and the vaccine. All of that stuff will be very bullish for the reopening stocks. You will see the rotation from the stay-at-home and the technology sector to the lagging reopening stocks intensifying under this scenario. Now, the other aspect that matters here in the outcome is the political response. Will he emerge victorious in this one? Meaning he will gain sympathy from voters and they will see him in a different light and his poll numbers improve. Right away, you will see a massive rally in stocks overall, not just due to the Trump's recovery optimism, but of course, expect more short bets to enter the market this upcoming week. If we do have an outcome where he recovers, the president of course, and he gains politically, not only the dip buyers and the current mentality invading the market will subside and buy stocks with both hands, but we will also see shorts scrambling to cover, adding fuel to the rally. However, if he does emerge from this weakened politically, where you see voters saying, yes, we're empathetic toward him, but he kind of had it coming and he is the wrong man for the job, he should just stay at home, recover, and move on, you will see the market and market participants reverting right back to the Biden scenario, which is sell before year end to lock in the low capital gains taxes before they get increased. So this is the playbook for now. But remember, this week was very, very hard to navigate through. It was a very difficult terrain for any technical analyst or any stock market analyst out there. Therefore, the big picture is very important. Looking at things from a macro glasses is very important. Remember what we've said before this week even begun. In the weekly outlook, the video I produced last Sunday, I said we will see a rally, specifically in the NASDAQ, for a day or two, maybe three, and then depending on the debate outcome and whether we reach technical resistance or not, you will see a reversal by midweek after the debate or before the end of the week. And indeed, if you followed that playbook and that strategy, you did very well this week, regardless of the volatility and the very difficult terrain to navigate. Of course, we saw the reversal happening today on Friday, and the expectation here that the downtrend will continue all the way throughout this upcoming week until we reach some of the support levels we talked about when we discussed the SPY and the Qs and Apple. And if we do indeed bounce from these support levels significantly, you will get another at least short-term bottom. But for now, I see the decline and the downtrend getting more intense in this upcoming week, because the uncertainty and this disaster that we have uncovered yesterday is not done yet. You will see more and hear about more names getting infected now, and who knows what's going to happen with the president's health, and it would just add a double whammy to a market that was already weakening, getting too hot and correcting to begin with. Add to that now the mix of the uncertainty and the presidential elections looming, and it is very rational that we will downtrend from here on.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.